Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just now to go down to the closing bell, and stocks edging higher here despite the rise in crude oil prices. Joining me now to help us make sense of today's market action, we got Yahoo Finance's Inez Ferre and Jared Blickery. Welcome to you both. Jared, let's start with you. What's going on with these markets?
All right, not too dissimilar from yesterday. Yesterday was a great day, and let's just go to the Wi-Fi Interactive. Not quite as bullish, but I'm seeing some incrementally positive signs here. So you're looking at the Dow Industrials, and they are up a whopping 98 points, so not the biggest deal, 0.2%. You can see pretty a little bit more bullish in the early part of the day. Here's the Nasdaq Composite up about twice as much as the Dow, and S&P 500 splitting the difference. What I like here, Russell 2000, small caps, little guys are outperforming. They're up more than any of these markets we just discussed, about 0.6%. Again, nothing to write home about, but it's just the broad bullishness here. So if I go to the very opposite end of the spectrum, and from small caps to large caps, Magnificent 7 ETF, that's in the green as well. Dow Transports, one of my canary, has been harping on that recently. That is up 1%, and the list goes on. Meanwhile, volatility, let me give you a year-to-date here. You can see it's dropping today by a point or so, and it is, well, it's off of those highs. Still kind of elevated above 20, but I think investors will take that. It's moving in the right direction. Here's the ICE B of A Move Index. It's very similar to the VIX, but it's for the bond market. So the point is, it is coming down as well from a peak a few days ago. And speaking of bonds, let's take a look and see what 10-year T-notes are doing. This is year to date. We're down 2 basis points today to 4.20, and the 30-year down to 4.85%. Nothing big going on there. So let's move on to the large cap sector action. Similar to yesterday, except we got a little bit of red. Everything was green yesterday, but today, we have healthcare and consumer staples, which is just kind of flirting with the unchanged line right there. But everything at the bottom is defensive, so that's not the biggest deal anyway. Another thing that's different, energy is the leader today. It's up about 1.2% there. Consumer discretionary, same as yesterday, that's the number 2 spot. Then you got financials, real estate, then tech, then materials. That is your top row there. So energy kind of switching places with tech. That's one of the big changes. And the Nasdaq 100, not quite as bullish looking as green as yesterday, but a lot of green spots, a little bit of dark green. Micron up 4%, Intel down 3%, and those are some of the biggest movers. So kind of a ho-hum day, even when you drill into the indices. Here's the Dow, a little bit more red we're looking at. You can see Boeing down about 1%, Honeywell down 4%, Amgen, Salesforce down 1%. Let me get one final look of the software versus chips. And Microsoft, well, takes up so much space that it really does kind of cast a big red shadow there. So let's take it on an equal weighted version. You can see a lot of green there. And in semiconductors, again, some of the big ones in the red today, but bullish picture because more than half of these issues are in the green. So that's basically what we're looking at. All
right, that's the stock market. What about crude? What's going on with the oil market?
So we saw crude go higher today. We saw WTI that's around $96 a barrel, and Brent crude is around 103. It's going higher for several reasons. One is that NATO allies of the U.S. are really reluctant to get involved with this war, getting involved by escorting vessels. Mm-hmm. They really don't want to do this. You have President Trump that also put out a social media post basically blasting these allies and saying, we don't need the help of anyone. Mm-hmm. But nevertheless, you're seeing oil going higher. The Strait of Hormuz, Wall Street basically saying that it's increasingly conditional, that route, meaning that Iran is letting some vessels go through, of course, not the ones that are allied with the U.S., but others are flowing towards China, towards India. And then you have Iran that's been also targeting UAE gas facility, also Iraqi fields with drones. So you still have that. The question is the duration of this really is what strategists are pointing to. And you have RBC Capital that said that you could see oil going to its levels of post the Russia invasion of Ukraine, if this lasts anywhere between 3 and 4 weeks and further, or for several months longer, you could see oil going to its 2008 highs.
You know, so let's go to the Wi-Fi Interactive. I wanted to show the energy space right here. I think stocks have been incredibly resilient throughout this. And yes, you know, you expect energy to catch a bid because crude oil kind of feeds into that. But when we've had really extreme crude prices before, and you could even think to the heights of oil in 2022 or in 2008, well, everything was in the red, including energy. And this is just a pretty good picture. What I like about energy, it was breaking higher. It was breaking higher to new highs before this whole war started here. And let me show you a chart of XLE. This is a large cap State Street Energy Fund. And if I show you a 1-year chart, you can see how it was just kind of coiling here, finally broke to the upside. And Josh, you and I have looked at this one before. This goes back to the beginning of the century, and you can see it was in a 2-decade range, and it is only now jumping out of that. And that started in January. So prospects for energy, that's just something I've been focused on just about every day.
What about, Jared, this relationship between oil and the market, in that we were in this sort of loop where we were getting up every day and it was like oil higher, market lower, oil down, right? This is the perfect, right? But now, does it feel like to you like maybe risk assets are sort of trying to figure out, okay, what's sort of the level we can live with?
Yes, the equilibrium level.
Yeah.
And $100 crude is going to catch attention, but let's remember, inflation adjusted, it's not even as high as it was in 2022 because we've had persistent inflation since then, and not even close to what we were seeing in 2008, which was $150 per barrel. So, you know, we've had some negative reactions to what's going on in the Middle East. That's more the shock factor. Things have gotten nice, I think, because people see an end to this, and maybe it's imagined, maybe it is. But until that rubber meets the road, you know, I think stocks will probably be green, but that next shoe can drop.
There's also this feeling that the U.S. is going to fare better than other countries because the U.S. is a net exporter. So there is also the framing.
And the shift we've seen in is also manufacturing to services, right? That's the other shift.
100%.
Yeah.
I mean, and the Industrials Conference was taking place today, the JP Morgan Industrial Complex, and you have now airline executives that have been saying that they have seen a uptick in demand because travelers are trying to lock in their airfares. So you have Delta that's saying that its sales are going to be up in March. Also, American Airlines saying something similar. Alaska Airlines saying basically that they've seen a demand uptick because of the surging oil prices, because they know that the airfares, travelers know airfares are going to go higher, and so therefore they're going to sort of pull forward that demand.
You also you had a good story, Nez, where you sort of brought a lot of this back to the consumer as well, what they're feeling. You had a number on it. You said Americans are actually spending $300 million more on gas than just a month ago. As you reported that out, and as how significant is that squeeze?
It's significant because whatever you're spending somewhere, you're not spending it elsewhere. So that's the whole sort of theory behind this, is that Americans are going to be spending on gasoline, so therefore they're not going to be spending in other places. And you have some strategists that are also talking about the One Big Beautiful Bill. It's been great for sort of tax incentives, rebates, et cetera. It's basically more spending that consumers will have because of the One Big Beautiful Bill. But there are strategists that are saying that the longer these higher prices stay like this, that's basically negating any benefit that you're getting from that bill. So even though you may see higher spending abilities in one area, they're going to be actually putting that towards gasoline.
I know you follow oil closely. You also follow Bitcoin closely. You had a new story out today where you were tracking how Bitcoin is outperforming stocks and even gold during this conflict.
It's been resilient. It's been resilient. If you take a look at since the start of the war, you are seeing that Bitcoin is higher. Meanwhile, equities and gold it's outperformed equities and gold, which both of those lower since the start of this war. So ETF inflows, that has helped quite a bit. You also have strategy that has been buying a lot, and then you also have long-term holders that Bernstein is talking about. You may have the retail holders that have panic sold, but you have the long-term holders that are still holding to Bitcoin. So even though it is in a sort of bearish trend, this is a significant rally.
What do the technicals look like on Bitcoin?
Yeah, Bitcoin is. I'm not that bullish on Bitcoin long term. I think.
Why, Jared? How so?
I think that we're going to get to a point somewhere around 85,000, and we're going to see the sellers come in force. But I think this is a positive development. If there's some huge catalyst that just makes it blast through 85,000 all the way up to 90, okay, I think then it would have momentum. We'll probably be looking at new highs. But I just get the feel based on prior crypto winters that if we go to the Wi-Fi Interactive, I'm going to point out something pretty interesting. But based on prior crypto winters, I just don't think we're quite done with the selling. So we do have that on screen. This is Bitcoin versus strategy from the beginning of the year. And this light blue line, cyan, is what strategy is doing. And so it's outperforming since this low that we saw in early February. That's a step in the right direction. Now, if I show you over the last year, you're going to see strategy has really departed from Bitcoin and it's still lagging quite a bit. And this happened around mid-year. This was before Bitcoin actually peaked. So this was a leading indicator, which means to me that this could be possibly a leading indicator. So if I were to be bullish on Bitcoin, this would be one of the feathers in my cap, just not quite there yet.
All right, Jared and Ez, great chat. Thank you both. Thank you. Well, housing market enjoying some welcoming news as U.S. pending home sales saw a rise in February, but it may be a short-lived victory. Yahoo Finance's Claire Bosson join me now. All right, Claire, so let's start right there. Contracts up 1.8%, my friend. So how much of that was mortgage rates dipping? And if that's true, okay, what would you expect ahead?
Right. So a big chunk of that number was likely these lower mortgage rates. In the month of February, which is what this data set is from, we saw mortgage rates finally hit 5.99%, which was very exciting to people. So when you look ahead, we are not there anymore. Mortgage rates today are around 6.3%. It's kind of unlikely that we are going to have a super strong March for contracts.
Why do you say that? Why, Claire?
It's a rate story. I mean, we really see consumers pull back as soon as rates rise. That being said, March is a little bit deeper into that spring home buying season. And so we may see some of that seasonality come into play. This is a month-over-month index.
In your story, you talked about, and I thought it was interesting, oil and geopolitics. How are those tied, connected to mortgage rates?
Definitely. It's kind of odd, right? What's happening in Iran is somehow affecting your mortgage rate. But really what's happening is people are looking at oil prices and they are getting worried about future inflation. And when they are worried about future inflation, then treasury yields rise, mortgage rates rise, and that's really what we're seeing right now. It's moving a lot day to day. We're in a really volatile time, and so we'll have to see. But the trend line has generally not been in the right direction.
All right, sticking with housing, let's talk about these Trump EOs, executive orders. Just to bring people up to speed, they're broadly aimed at addressing the affordability issue. There's two per reports. Under the first order, federal government, Claire, would reduce its own housing regulatory burdens, so make it easier for builders to construct homes, right? The second order makes it easier for smaller community banks to provide home loans. I mean, bottom line, what do you see the president trying to achieve here? Do you think he'll be successful?
Definitely. So I'm most interested in that first one, which is the regulatory burden one. This is the first time we've seen President Trump really try to address supply at all. His goal is to get more builders into the market. That being said, it's a pretty rough environment to be a builder right now. Generally, they're just not selling a lot of homes. The prices feel a little high to consumers. And then on the other side, you've got this mortgage rate initiative. And so what they're trying to do there is just bring more lenders to the market. Community banks have been pretty out of this market since the financial crisis due to regulatory changes. And so the goal is just bring them back into the market. Then consumers will have one more place to choose from, and that should help mortgage rates go lower. We will see, though. I mean, there's only so much you can do as a president because so much of housing regulation is very local.
State, local.
And then, also on the community bank side, if they don't feel like they're going to make money, they're not going to come back in.
Since you mentioned builders, let's talk builder sentiment. Not great. Not great. I mean, yeah, it ticked higher, but you're still here at 38. Some numbers that jumped out to me, Claire. Nearly 2/3 of builders still offering incentives. Over a third are cutting prices. What does that indicate to you about just kind of overall demand out there?
Definitely. We talk all the time about affordability, and the bottom line here is that affordability is still not great. And to get people into homes, builders are still having to offer those big incentives. Mortgage rate buydowns are the really common one that we see, and that is a direct result of mortgage rates being north of 6%. Builders will often step in, offer an incentive to buy down your mortgage rate, often to like a sub 5% rate, and that's what they need to do to get people into homes at these current prices.
Finally, a good story out of Bloomberg. Zombie mortgages, Claire. Explain in very simple terms, then we'll get into it. What is a zombie mortgage? It sounded like, it's like a dormant second mortgage that then resurfaces? Is that what it?
Yeah, so zombie mortgages, don't freak out, guys. You probably don't have one. They are basically very old second mortgages from the pre-crisis times. And generally, if you haven't been paying on them, they are probably so old that they're no longer collectible. However, that doesn't mean debt collectors won't try. And that's causing a lot of issues for people who have them. Sometimes they don't know. They find out a debt collector's coming after them.
Yep.
And worst case scenario, they could lose their homes.
Well, is this issue, is that something, Claire, that's sort of, you would think of as kind of niche, or no, this is potentially like widespread consumer risk?
Yeah, this is something that's fairly niche. However, for people who have these zombie mortgages and maybe don't know or didn't realize, they could potentially lose their homes. They could go into foreclosure here. And so it has really big risks for these people. It's niche, but the issue at hand is that the statute of limitations for collecting on this debt is over. That doesn't mean collectors won't try. And so these people may end up paying on something that they don't have to pay on anymore.
So bottom line, let's bottom line, stepping back, all right, if you look at this housing market as it stands right now, the fundamentals, rates, affordability, supply, how would you sort of characterize it? Are we seeing the same? Are we getting a bit better? What do you think?
So if we're comparing last spring to now, we are objectively in a better place because mortgage rates are lower. Home prices are not rising super fast. Wages have been able to keep up. So those are positive. However, we have all these unknowns. People are still really worried about the job market. We have all these Iran and inflation unknowns. And so that could potentially keep people sidelined headed into spring. But the ingredients for something a little bit better are there.
All right, Claire, as always, thank you.
Thank you.
Appreciate it. Coming up, I'll be joined by Gecko Robotics CEO to discuss the company's latest deal with the U.S. Navy. Pittsburgh-based robotics startup Gecko Robotics announcing a $71 million deal with the U.S. Navy to use its AI systems to repair military ships. Joining me now, we've got Jake Luce-Ararian, Gecko Robotics CEO. Jake, it is great to see you. So let's start with this news. This is big news for you guys. U.S. Navy awards you all a contract. It's worth up to $71 million. What work will your robots be doing exactly, Jake? Like, break it down for us in simple terms.
Yeah, absolutely. Well, the robots are going to be swarming all over the vessels. And basically, the thing to understand about what our systems do is we send out robots to gather information about the health of critical infrastructure. So it started in energy, then it was manufacturing, and then it kept on going into more and more sectors. And 4 years ago, we started working in the defense. And what we're doing is assessing the health to ensure that we can expedite how quick we can get vessels that are supposed to be deterring conflict around the world actually back in the fight way quicker. So the robots have been proven to increase speeds by 3 to 4 months in terms of speed to get ships out of dry dock and back out and patrolling the seas and helping the warfighter be equipped with better equipment, and then also way more accurate in terms of data sets and creating a source of truth that helps to ensure that we can meet the Secretary of the Navy's goal of 80% readiness. And that's quite a large goal, but the Navy is clearly leading the way here.
You mentioned that data point there that I thought was interesting. You can identify repairs, you say, up to 50 times faster and more accurately than manual methods. How does that sort of translate into like sort of actual cost savings for the Navy, Jake?
Yeah, well, deterrence is what it's. Deterrence is you have to ensure that you have assets ready to be used to deter around the world. And so this is a global problem. Everyone's dealing with this, especially with aging infrastructure. And so you have over budget in terms of turnarounds and maintenance cycles. You have maintenance cycles that go way longer than they ever should. And the only way to combat this is with superior information and intelligence. And that information and intelligence simply doesn't exist unless you go out there and collect it by hand. So these tools that we've enabled humans with is the ability to, by, like you said, 50x, create millions of times more information and data sets to be able to help optimize and use AI to optimize where to fix and replace and repair things without having to tear apart the assets, or in this case, the destroyer or the amphib or some surface vessel, to be able to detect and understand where there is need of repair to get that ship back in the fight and arming the warfighter with the best technology that we can to be able to do so. And so, it's the saying that we always talk about at Gecko is if it's not ready, it doesn't count. And that's really important as it relates to what's going on around the world today.
I think I read, Jake, this contract, so you started with, is it 18 ships in the Pacific Fleet, I think I read. How quickly do you think you can scale this in the Navy, allied powers? What do you think's ahead?
Well, we're already being pressed to compress the cycle of how many ships we can get on within that first 9 to 12 months. So that just means we have to continue to scale up how many robots that we have, scale up our operations. But right now, what's clear is that this is a technology that's leading the way. There's no one else who has the kind of ability to create this digital thread of health. We've been creating digital threads of health for 13 years using these robots. We've had the most robust data set about the health of materials and how to ensure that things are supposed to, when they're supposed to work, they work. And we want to create a future where if things are never down unless you want them to be. And you can only do that for the ability to predict. We kind of talk about ourselves as like we're creating the Minority Report, if you will, of the physical world. It's like instead of like predicting murders, right, with the precogs, you have our robots that are collecting information and ensuring that you never have a catastrophic failure, or you can always predict when something's going to break and fail. And that's what we're doing and bringing that to the Navy and one of the largest robotics contracts ever signed by the government.
Jake, how do you think? I'm just curious about the primes, because we talk a lot on the show about the traditional big defense contractors. You think of them as sort of like their rivals, their partners, their potential acquirers. How do you think about them?
Yeah, our mission was pretty clear at the beginning. It was, when I started the company, in particular when I was in college, I saw that the heroes that ensure that the power stays on and that that we have the port engineers making sure that the vessels are ready to go for the warfighter. These folks, they are heroes. But these heroes don't ever get the best and the brightest technology. And it caused people to die and to get injured all the time. And so we wanted to create a company that could build technology for those people, for those heroes that are unseen, that ensure that our daily lives go as smoothly and as optimized as possible, and in some cases, in the military case, defend our freedoms. And so we want to equip and be an enabler to primes, to be an integrator where necessary. But in some cases, it's just very clear that this technology is a completely new way of thinking about what it means to predict, prevent, and even optimize, and have an understanding of what's going on with these critical pieces of infrastructure, whether it's energy or it's military. And so that must mandate, in some cases, a new prime emerging. And so that's what's happening right now in Western Pennsylvania. Funny enough, a prime is emerging that's supporting this critical ecosystem, this critical component of what it means to deter conflict.
What are the unit economics here, Jake? I'm just curious, like an investor, how should they sort of think about your company or value your company? I mean, do you think of like hardware business, software business, is it or some type of hybrid?
They should value it extremely highly. Well, I mean, you can understand, you can imagine the data that we're collecting, no one else has, right? We've been doing this for 13 years, diagnosing the health of the built world. We're the doctors like creating this like incredible data set, and that data set is now allowing us to build models and algorithms that no one is even close to as it relates to predicting when things will fail, what sorts of information we should collect to build smarter infrastructure, and that's what we're doing on the manufacturing side, the shipbuilding side. We're integrated into our technology is there. And so, what it speaks to is the importance of a hardware-defined software that's collecting information data that never existed before, turning atoms into bits, and then turning those back into atoms, meaning arming folks on the ground, those heroes that I talked about, with better tools to repair, to make decisions about what to do to ensure catastrophic failures don't occur, and that we can be smarter at planning and preventing and getting things that should be working back working again. So it's you should value us as a N of one here as it relates to a company that's defining what the future looks like for both things.
Right now, Jake, war is front and center, geopolitics is front and center. When those geopolitical tensions ease, war moves off the headlines. What does that mean for your business? Does that mean business slows? What's the impact?
The impact, what we're seeing now, and I can't speak too much about the exact vessels and ships that we're on, but we got a task order. The $71 million is being deployed already. I mean, it was this month we got awarded. 2 ships were on already, and these ships are very important as it relates to what's going on in the Middle East, and ensuring that they're ready to go. Again, as fast as possible. You can't have these vessels, going over budget and over time in terms of turnarounds. And then on the Pacific side, we have to understand there is a moment right now to ensure that there is not ideas that are hatched in the Pacific side while we're focused on the Middle East. And so it's important in the Pacific fleet side, 2/3 of this contract is specifically dedicated to surface fleets on the Pacific side, that we have as many vessels positioned in strategic locations and not sitting pier side or at a base somewhere, whether it's forward deployed or in the U.S. We want to make sure our chess pieces are able to be used and deployed, opposed to sitting around and not being used.
Final question, Jake. I read you were last valued at about $1.25 billion. That was in a $125 million funding round back in June. Do you all require, significant more capital to scale from here? Walk me through that.
Yeah, so with robots, what we're seeing is that we can do more and more with less and less humans. So we continue to need to invest into these different sorts of swarms of robots, different types of robots that are going out, whether they're swimming, they're flying, they're crawling, whatever they're doing, collecting information and data sets. But I've talked about this a long time. We are creating the software that enables the most amount of value creation from robotics, period. In these like physical worlds, these worlds that drive industries and drive defense and the government. And so what that means is that as humanoids come onto market, as other robotic systems come on, as an emerging prime, we are the ones that help to create the most ROI and figure out what sorts of information, data sets, or actions are needed to be taken, whether it's welding, whether it's inspecting, whether it's walking around and actually doing actions. It's ensuring that we can create this future that looks a lot more like Star Wars as opposed to Terminator, with making robots the most impactful economic driver for the U.S. and its allies as fast as possible. And Gecko's the only company in the world that's proven time and time again to do that, not in 5 years or 10 years, but today. And that's why we're having so much success.
Jake, great to have you on the show today, especially on set. Thank you, sir.
Thank you.
Well, Nvidia's Jensen Huang forecasting that AI chip sales will reach $1 trillion by 2027. Julie Hyman spoke to a panel of experts on Market Catalyst this morning about what this could mean for the AI trade as a whole.
As we talk about the interconnectedness of all of this, right? Something else that strikes me as I look at some of the products that that NVIDIA is talking about, whether it's NemoClaw or it's now LPUs, language processing units, is again this maybe quest, whether it's probably I was going to say implicit or explicit. It is explicit, to try and get its clients very reliant on its full system, right? And so I'm curious what you think of that strategy and how much what we heard yesterday sort of again contributes to that.
Yeah, I think that's exactly right. Up until now, really, NVIDIA's had a very GPU-centric focus. They're more of a one-size-fits-all. And now, to build on what Ivana was saying, they're saying, no, there's multiple paths forward. We could use copper, we could use co-packaged optical, more variations on the software. And importantly, I'd say the most important takeaway from yesterday is around the introduction of the Grok technology into the system. So now, with Grok integrated into the NVIDIA systems, their ability to do inference and do it inexpensively and at a very rapid pace extends their lead over Broadcom and AMD. There was some concern that AMD is becoming more competitive and there were custom GPUs and there's the Broadcom ASICs. And what NVIDIA is doing is now extending its range to say, we're not just GPUs that are very good for training. We can do inference better than anybody. And Grok was really critical to that. And that's what they introduced yesterday, was how much more effective they're going to be at inference because of the integration of Grok technology.
Gil, do we know what the margin profile of those kinds of products look like versus the GPUs?
Well, NVIDIA's been able to keep its margins in the mid-70s throughout this cycle, with manufacturing delays, with implementation delays, with new product sets. They have all the pricing power, and that means that they're likely to be able to hang on to those level of margins, especially as we are in the aggressive part of the build-out.
Ivana, I want to go back to something that Gil was talking about this belief by the market that we're at peak spend in terms of CapEx. And I'm curious what you think of that and whether you agree that we still need, or the market needs, whether you guys believe it is one thing, whether the market believes it is another thing, and what kind of proof points might be necessary.
Well, I think Gil was spot on in that we do need to see further CapEx increases from the hyperscalers. That's really the key number to watch because they're over 50% of NVIDIA's business. So really, that's the one data point to focus on. But I think the numbers are the numbers. So if you get to 27 and NVIDIA is putting up $15 in EPS, there is no way the stock can stay at this level. So these companies very rarely trade below 10 times PE. And we believe once people see the numbers, there is really going to be no way not to drive the stock higher.
Gil, just sort of more broadly, it's not just obviously in the infrastructure builders like an Nvidia that have been sort of sideways, right? Although sideways is the best case. A lot of companies in the AI stack have been down. We've talked about this a little bit before, and especially now that there's so much noise from the war, for example, in Iran. What do you think is going to kind of change the narrative, if any? And do you think that's coming anytime soon?
The more we use AI, the more it becomes compelling at the consumer level, at the enterprise level. The more pre-sold these data centers are going to be, the more the big data center companies, Microsoft, Amazon, Google, Meta, will continue to build them out. And it's going to be a self-fulfilling prophecy. And we had breakthroughs with ChatGPT, and ChatGPT got a lot better. And now we've had breakthroughs with Claude and Opus and their ability to help us with coding and create tools at work, which are creating incredible demand for compute, which is precisely why these companies are building so much. So as that virtuous cycle continues, investors will start getting comfortable that that's the new normal, that we are going to incorporate a lot more of our economy through AI, and therefore we do need this compute. And that's going to result in these companies outperforming. And to Ivana's point, Nvidia is trading at a market multiple. It's going to grow 60, 70% this year, 30, 40% next year. That's not going to last. As long as they continue to grow at these rates, at some point, the multiple is not going to contract anymore, and they'll be able to outperform. And the same is true for companies like Microsoft, also trading at close to a market multiple with very predictable mid to high teens revenue and earnings growth. Those are artificially deflated multiples because of these concerns about next year. The closer we get into next year, the more people are using AI, the more confidence they're going to be in a continued data center build out. That's when these stocks outperform.
All right, we shall see. Ivana Gill, thank you so much. Appreciate it.
Coming up, Warner Brothers Discovery CEO David Zaslav is set to get a massive payout. The company's sale goes through. We'll give you all the details. That's coming up next. From markets to Main Street, scarcity and shakeups are intensifying everywhere as part of the stories we're watching. Yahoo Finance's Brooke DePalma and Ez Foray join me here for a closer look. First, I want to start with the potential change to requiring quarterly reporting from public companies. So this one, Brooke, we got a report that says the SEC is preparing a proposal, I guess, get rid of the requirement to report earnings quarterly, instead give companies the option to share results twice a year. What do you make of it?
Yeah, so as opposed to 4 times a year, it'd be twice a year. Now keep in mind, it's not official yet. Once it's published, it's subject to a public comments period. After that period ends, that's about 30 days, then the SEC will vote on it. But this is something we've been talking about for quite a bit. And just last fall, when this news first jumped out, I actually asked Best Buy CEO Corey Berry about it to get her take. She said during volatile times, it's great to provide sort of a context to what's going on. Not necessarily a forecast, but just more color. But at the same time, she did say it would be kind of nice to free up capacity and make sure we're spending capacity in the most value-added areas. So it sort of sounded like would be nice to have a little bit more free time. A lot of costs with this as well.
Yeah, I mean, it's expensive to do this, right? You have to do this quarterly. So it is an expensive process. They want to bring in more companies to be able to go public, to not have to have that quarterly date that they have to constantly be meeting. And it's not unprecedented. I mean, in Europe, they did this back in 2013, but you still have a lot of companies that still report quarterly. quarterly. So if
So
this
then
were
it's
to
kind of like
happen,
they choose?
right, so you have the option of doing biannually or you have the option of doing quarterly. So the expectation is that if this change were to occur, companies, probably the big ones, would still go quarterly. Maybe smaller ones would do biannual. It just depends.
I think that's a good point, because I think if you're a big company, listen, getting ready for an earnings day, so people understand, is a massive operational lift. Like, you have so many people to check. You've got to check off IR, operations, legal, accounting, comms. It's huge. And to your point, that is going to be easier for a big company than a small company.
Yeah. And now it's become more showy, right? I mean, you have 100%. Some of these earnings where they're on YouTube and you're seeing them on camera.
Yeah, Walmart streams on YouTube. I think Netflix is too.
Completely. They've become sort of a show for a quarterly show.
Yeah. And
Go ahead.
And I was just going to say, I think that you wonder too, it's like, if you don't have these quarterly earnings, though, how are investors getting more information? And that might be a bit of a struggle.
I hear that, but you know what? There's a lot of ways. There's investor days and analyst days, exec speak at conferences. And frankly, and we talk about this on the show, there's all kinds of alternative data that's available as well. And we'll see how it goes. Topic number 2. How about this one, Brooke? The Journal noting, this is an interesting inflection point, service tenants now make up over 50% of retail leasing. So when you're hitting the mall, it's no longer about stuff.
Yeah, it's not even the mall, though. It's like everywhere you go, you walk past. With the rise of e-commerce, why do you need so many storefronts? We're revolving and moving forward into like more of a D2C community. Plus, I feel like with less people, young people drinking, you have more Pilates studios, more wellness spas. Even within this article that we're referencing here, even Planet Fitness is one of the main points that's taking up vacant mall areas like Joann's Fabrics, things like that. I think we're just moving into a more society where we focus on experiences and less on maybe physical purchases.
Maybe it's a lot of social media, Nez. Maybe it's
social media,
yeah,
100%.
because I want to feel good, I want to look good, I want to post it.
Yes,
right?
I mean, the wellness industry is huge, and it's booming more and more. So there is that wellness to that, and then there's the issue of, as you said, e-commerce, and this really speaks to a trend, though, overall. If we think about what we're talking about, like AI and robotics and everything else, services is where it's at. I mean, you can buy a shirt online, fine. You don't have to go to a strip mall to get something like that. But if you want to go get if you want to go to a tanning bed, or if you want to go to the gym, you need to go in somewhere physically, or physical therapy. There's tons of those as well. This is the service industry where you need that physicality. That's where it's at.
There was a part of the story too, apparently, Brooke, is GLP-1s. Right? The idea that, like, all right, you got a lot more people, they're cutting weight, now they got to tone up.
Now they got to tone up, exactly.
That's what it is.
I mean, you just walk around New York City and you see yoga studios, Pilates studios. I feel like a new one opening up actually every single day. I don't know about you guys, but I think we're just overall, not only is GLP-1s impacting the snacking industry and all of that, but it's also impacting the wellness industry, where we're seeing a huge boom. Even Planet Fitness, I was telling you, vibration plates, red light therapy, all these services that people are now seeking, and they're very careful about where they're spending their money. So maybe they'll splurge on the $200 a month membership and less maybe on buying more clothes.
And it makes sense to put them in areas where there is a lot of foot traffic, right? So you want a lot of people to go in there, and areas that tend to be near highways or near main routes, where it's easy to get in and out, and then you go get your service, you leave.
All right, finally, Inez, summer camp. Let's talk about that, all right? Summer's months away, but as a parent, great story here about how you're already booking camps. You got wait lists. Things are sold out. You're getting stressed out. What do you think?
I see this. Last year I missed the window, and this year I said no more. So I actually put it on my calendar on the day of that registration started.
What day was registration, guys? It's only March.
In February. February was the one that by the way, I've had to do 2 because they're not the entire summer, of course. It's like 2 weeks here, 1 month.
You've got to start stitching it together.
Right, you have to
because you're only covered for like a couple weeks at a time.
Exactly, but you need the entire summer. So you're stitching all these together and trying to and not only that, but they go from 8:30 to 3:30. So then you need the aftercare. There's add-ons to it. It's hot. It's very costly, and there's a huge demand because usually you have 2 working parents that cannot be with their child, so you need to put them in summer camp when they're not in school.
Right. Some of these costs are referencing $87 per day. And overnight camps anywhere from $173 per night, depending on amenities, location, and that's probably being generous. Are we being generous with that rate? Probably.
Yeah, completely.
Yeah. And I just wonder too, what does this mean for someone? We're talking about how now higher gas prices are impacting lower and middle income families. That's simply impossible then to even do this. I went to public school camp.
You will cut where necessary to get that kid out.
Because it is like childcare. I mean, that's what it's
100%.
basically become is a type of childcare.
Also, I think though the 2 of us are in that tough spot because 4 and 6.
Yeah.
See, when she gets a little older, you ship her off to sleepaway camp with her cousins. But 4 and 6.
I don't know, but this camp thing has been a growing industry for years because when I was a kid, it was like go play with your brothers and sisters. That was basically it.
Right. Yeah, I went to like my local school and we just sat there for about 8 hours and then I went back home.
That's a great experience.
It was.
And good for you and mom and
it was
dad.
cheaper.
Yeah, Inez, Brooke.
Maybe a little cheaper.
Thank you. Well, Warner Brothers Discovery CEO David Zaslav potentially pocketing up to $887 million tied to the company's sale to Paramount Skydance. For more, we're bringing in now Yahoo Finance's Brooke DePalma and Jake Conley. Jake, first of all, just break down that number. Nice payday. What's the breakdown for us?
Nice payday indeed.
Yeah.
And as we said at the top, this is the max he could get. This is an up to figure, and some of this is contingent on the deal closing, which Paramount expects in the third quarter. That said, what you're looking at, $517 million in equity, $34 million straight in cash, $44,000 in benefits, they categorize it as, and then tax reimbursements of roughly $335 million, though that goes to zero if the deal doesn't close this year. So again, a lot of this is contingent, but still, it's quite the nice payday.
Beyond Zaslav, any other WBD executives seen a similar payday?
Several golden parachutes here. Warner Brothers Discovery CFO, golden parachute. CFO Gunnar Weidenfeld's $120 million.
Wow.
Chief Revenue Officer Bruce Campbell, $121 million. Streaming and Games CEO JB Perrette, it's $142 million. President of International Gerhard Zeiler, $83 million.
It's good to be the king.
Good payouts.
Good to be the king.
Good payouts.
And he's sort of riding high right now because even after that, nice payout announced today, you also had the Academy Awards just last week. And in a memo that he sent out to employees, he actually took the opportunity to say, hey guys, we're really getting ahead. He said last night was a remarkable moment for Warner Brothers Discovery. Our films won 11 Academy Awards, including Best Picture and Best Director, the most of any media company this year, maybe taking a dig at Netflix there. Went on to say, which we saw recognized last night as a reminder that this team is truly like no other. And this might be 20 years in the making for David Zaslav. He joined or led Discovery since 2006. And then in April of 2022, he spearheaded that transaction between AT&T, Warner Media, and Discovery. Now, 4 years later, he's off to Paramount Skydance.
You have to remember, 2 or 3 years ago, this was, quote, the most hated man in Hollywood. Now look how far he's come. It's nice to be the king.
Nice to be the king indeed.
What do you think shareholders make of this? You think it makes sense? Do you think it's excessive? What do you think?
I mean, I think there's a conversation about executive compensation and the fact that David Zaslav has been one of the best paid executives in the country for years now. But consider the background here. Before Paramount got involved, Netflix was essentially at the finish line
100%.
to take the studios and streaming for about $83 billion. This deal for Paramount is $110 billion total. So you could argue that David Zaslav essentially managed to negotiate an extra roughly $30 billion for shareholders. And this is an all-cash deal. That's $31 a share getting paid out in cash. If I'm a shareholder, I'm probably not too upset because of that payout.
Just remind us again, Jake, the TikToker, what allowed the Ellisons, Paramount, to get this done?
Well, it was 2 things. Really, what it comes down to is that the shareholders, this board at Warner Brothers Discovery, was concerned that Paramount wasn't capitalized enough for this. They didn't think David Ellison had enough money behind him. So Paramount did 2 things. First, they switched to an all-cash offer. Say, we're going to give you all the money. This isn't cash and stock. This is just cash. The second and more important thing, Larry Ellison, too many Ellisons, Larry Ellison founder of Oracle, David Ellison's father, has agreed to personally backstop $40 billion of this in equity financing. Again, one of the world's richest men. It is good to be the king that you can get your son's deal for one of the most storied film studios in Hollywood across the finish line.
And on top of that, too, Paramount Skydance is now also paying that termination fee that Warner Brothers needs to pay Netflix. And that was a big contingency, too, because that was pretty significant. I don't really remember the exact number. I think it was something like maybe $2 billion?
2.8 billion.
2.8 billion. And so that was another reason that this helped get to the finish line as well. So Netflix, even still benefiting in the end, they get this termination fee paid to them. And then on top of that, too, this was sort of like a nice to have for Netflix, not need to have.
And here's the other thing about Netflix. Right after the deal was announced that Paramount and Warner Brothers Discovery were going to move forward, then Netflix was going to back out, Netflix stock pops. Paramount Skydance has suffered since this deal. Netflix is still flying high. I think there are some investors at Netflix saying maybe Ted Sarandos got the better handle of this. He's not going to be inheriting all of this debt that this deal is going to be saddled with. But I think that's for the shareholders to decide. But Netflix shareholders seem to like that decision.
All right, Jake, Brooke, thank you both. Appreciate it. Coming up, Circle gets an analyst upgrade, what this means for the company and USDC. Clear Street has upgraded Circle to a buy rating. It says the current financial environment will prove a catalyst for stable coins to grow. That analyst, Owen Lau, senior analyst at Clear Street, joining us now. Owen, it is good to see you. So let's dig right into this. You upgrade Circle to a buy. You raise your target significantly, Owen. You go to 136 there. In terms of the catalyst you see, one is tokenization. Maybe start there. Walk us through that. How big of an opportunity is that, Owen?
So first of all, thank you for having me. Good to be here. The first catalyst, tokenization, is huge. In terms of the trend, when you look at the AUM of all these tokenized private equity, tokenized money market fund, and tokenized private credit, the AUM has grown by over 200% to right now around $26 billion at the end of or maybe in the first quarter of 2026. So you can tell the growth has been very fast. And in terms of the TAM, it can become like a $10 billion opportunity for Circle longer term.
I thought it was interesting, Owen, in the note, you also mentioned conflict in the Middle East. How does that play into the Circle story?
Yeah, this is another interesting story, because if you look at the people in Dubai or maybe in some other Middle East regions, if you look at the status, I think the exchange in Abu Dhabi and also Dubai were closed for 2 days. Some of the banking operations were also paused. So people there, they had no access to traditional banking system. So what they had to do is to go to internet money, such as USDC or USDT, and get access and use Circle payment method, which is like USDT, to make cross-border payment and also remittance. So that's why it is very substantial for people in the Middle East region to access to this stable coin for transactions.
You also, you highlight some newer demand drivers, prediction markets, AI-driven payments. Are those already gaining traction? Are those already meaningful today, Owen?
Yeah, it's not meaningful today, but it's gaining traction. So for example, Polymarket and Kalshi, they're gaining a lot of market shares in terms of the prediction market, in terms of the swap contract space. And if you look at the growth rate, it has been growing at about over 200% year over year. So what USDC does is it becomes the settlement layer for prediction market, DeFi prediction markets such as Polymarket. So when people transact, settle, they don't settle in fiat, they settle in USDC, which is the default base currency for some of these prediction market.
What about regulation, Cohen? How important is the Clarity Act to your bull case?
So for Circle, it's interesting because Circle has the Genius Act already. So Clarity Act is just another catalyst to support higher transactions in crypto trading. It is important, but not as important as some other stocks such as Coinbase, because if Clarity Act gets passed, it may support higher trading volume for altcoins. Indirectly, it will support the demand for USDC as well. But at the core, USDC or Circle get the Genius Act already. So they have the foundation to support the growth of this trend going forward. So again, Clarity Act, it's important, but it will become just like an other proponent for USDC to go up going forward.
Owen, great to have you on the show today. Thank you.
Thank you.
Coming up, we've got you covered all the action following the closing bell. Stocks ending the day higher here, gaining more ground from Monday's rally. Our very own Jared Blickery has the latest. Jared.
Guess what? We're stringing together 2 days here for most of the indices that we're going to talk about. We'll start with the Dow up about 47 points or 10 basis points. Not the biggest day, but I think investors will take that. That's a 1 month chart. Let's get that on an intraday. You can see almost gave up all the day's gains, started out in much more positive territory. Nevertheless, a win is a win. Nasdaq Composite up about 0.5%, and the S&P 500 about half of the Nasdaq. And moving on to the small caps, outperforming all of them, up about 0.2%, and impressively holding on to most of its gains throughout the day, even though some of the large caps, they gave back some of those gains. Now here are the Dow transports. This is one of my canaries. I've been harping on them. Very solid performance, up another 1% there. We got the VIX volatility index. That's moving in the right direction, which is down, still a little bit elevated. I'd like to see it come below 20. And then in terms of the bond market, we got yields going down. 10-year is down 2 basis points to 4.20%. 30-year is down 1 basis point to 4.85%. And moving on to the sector action, we'll take a look at the large cap index for, here we go, large cap heat map. And energy, by far and away the best performing sector of the year, is at a record high today. I think that's number 17 for the year. Anyway, energy number 1, consumer discretionary number 2, and tech number 3. So if you remember from yesterday, tech was in the lead and consumer discretionary was second. So interesting leadership, the way that's emerged over the second day here of the week. Now, in terms of the losing sectors, all three of these are defensive, and so this isn't the biggest deal, but I would note that healthcare down 0.9%. I'm going to show you a year-to-date chart. It has just undercut its low here, so you'd have to go all the way back before the beginning of the chart to November to see a lower price in healthcare. That just tells me this particular defensive sector is starting to break down right now. But in terms of the bigger picture, as long as tech is in the leadership position or near the top, doesn't matter that much. Here are the Dow Jones Industrials. We got IBM up 2%, Disney up about 1.5%. Not a lot of outperformers. Looks like Goldman Sachs also up about 1.5%. To the downside, though, we got J&J. There's that healthcare trade down 2%. Boeing Industrial down 1.2%. Industrials have been flagging recently. And I'm going to switch over to the Nasdaq 100 to talk about the mega caps because we got a few others in there. Alphabet, big win there, up 1.75%. Amazon close behind. But in terms of some of the chip stocks, we got Nvidia and Broadcom. Not a terrible day, but not the best day. Each of those down less than 1% for Nvidia, a little bit more for Broadcom. Meta also off about 0.75%. Intel, a little bit different story. That stock is down 3%. I'll go into the transportation stocks, and then I will give it back to you, Josh. Excuse me, here we got Uber up 4%. Delta, a pre-announce on earnings. Looks like not only is demand on both the consumer and business side good, but margins also holding up in the face of all that higher cost of jet fuel. That's up 6.5%. United up 3%. And American Airlines, they also updated, and 3.5% win for them. Josh?
All right, Jared, thank you. Appreciate it. Let's take a deeper look at the markets now as major averages close higher today. Bill Davis, Hennessy Fund's Sustainable ETF Portfolio Manager. Bill, great to see you. So maybe start big picture, Bill, because you know how the rotation away from mega cap stocks has been slowed, you say, down by the war. So walk us through that, Bill. Do you think that's sort of is that a pause or no, something more structural has happened?
Well, first, Josh, good to see you. I'm out at an ETF conference, so I apologize for the subliminal messaging behind me, but it was the best I could do in my hotel room. No, I actually think that it's a pause. Like, I think at the beginning of the year, we began to see the AI trade breakdown and a rotation, I think, back to, more market breadth, which, like, I'm a fund manager within Hennessy Funds. This is the kind of market we like. We're all like high conviction managers across 17 funds. And so we've been seeing this happen all year. The irony to me is that just as we were trying to rotate away from a specific sector, that sector became the place that the market retreated back into a little bit when the war started. And so I think a lot of these sectors have taken a pause, and I was just listening to the segment before this about healthcare. But I also think that sectors aren't what they used to be also. Like, in other words, both industrials and healthcare are kind of catch-all sectors that have a lot of subsectors in them, and sometimes it's it's a tech company that services the healthcare market that's now been recharacterized as a healthcare company. And so I think when we look at sectors, it's probably more useful to look at individual names than just think about sectors. But I do believe that this is a pause, and that we have entered, and we're going to continue to be in a phase where there's just more breadth.
You actually compared, I saw here, Bill notes, you compare what we're seeing now broadly to the tariff wars of last year. How so? What do you mean by that?
Well, because I think that they were executed in a haphazard manner. And I'm not commenting on the prosecution of war, but I do think that markets like certainty, and if you just think back at what happened with the tariffs when it was, up 5%, it's going to be a 5% tariff. No, it's going to be 50%. No, it's going to be 25%. And every day it was a different, message. And I think that the messaging on the war has also been somewhat suboptimal from a market perspective. And so, the question is, you've got all of these companies and sectors that are either positively correlated with the price of oil or negatively correlated. Most of the market is negatively correlated. But I could see, oil jumping $20 on a day just based on what comes out of the administration, or dropping $20. And I do think that this is not going to be quick. And I think that we're going to see high-priced energy, oil specifically, for a while. But I think, like tariffs, people are going to get used to it and are going to adjust to it.
It's interesting, Bobby. You're a long-time investor, long-time student of the markets. How do you try, Bill, to sort of distinguish, okay, this is headline-driven volatility, this is noise, versus, okay, this is real material structural shifts going on? What do you look for? What's on sort of your radar, Bill?
Well, number one, we are a systematic shop, so we are not reacting. This portfolio was rebalanced at the beginning of January, and we're going to rebalance it again in about a week and a half. So barring something extraordinary happening within a company, we're not going to touch the portfolio intra-quarter. So we are systematic investors. We are not, and we're also very active. Like, our portfolio turns over probably 40% of the names every quarter. So there's names that are in the, well, actually, let me get back to answering your question. I think we are looking at fundamentals more than anything else. We did not think at the beginning of this quarter that we needed to have a war portfolio, if that makes sense. So we are looking at the intersection of statistical data, which causes us to believe that companies are statistically more likely than others. Certain companies are more likely statistically than other companies to generate positive alpha and total return for the next 90 days. And then we combine that with risk optimization. So in some cases, we might like a name, but we may assign it a weight of 0 if it looks too much like another name in the portfolio, or if we think that it poses significant tail risk. And so this portfolio, which is really, generally speaking, a large value portfolio, is really quite focused on downside risk protection.
Bill, let's end here with some names you like. Dig into those. Let's talk about Dow. That stock is up around 50% this year, Bill. Why is that a name you like? Why do you stick with it here?
Well, Josh, I'm sticking with it for another week and a half. We'll see what happens after that when we rebalance. But I would tell you that, and certainly we didn't know this when we bought it, but there are elements of Dow's long-term business and diversified nature of its business, its lack of dependence on a global supply chain, that to us made it sort of an interesting, sort of a value play. I don't think we certainly expected, nor did probably a lot of people, that it would be up 58% this year. I think it's up about 50% since we bought it, because we rebalanced on like the 4th of January or something. And what's crazy about Dow, to me, it kind of speaks to the craziness of this market altogether, is the street expects that on their upcoming report that they are going to be reporting a 9% drop in revenues and a absolutely massive drop in earnings, and yet, Citigroup just issued a analyst report recently and basically was forecasting a 40% increase. I think that's not exactly from today's price, but maybe as of, a week ago. And I noticed Wells Fargo also just set a price target of, I think, $40 for it, which indicates that there's still room to move on the upside, potentially.
Bill, what about ADM? That's another one. Nice, strong move over the past 12 months here.
Yeah, like 60%, I think. And it's up about 19% since we bought it at the beginning of the year. And it's interesting, prior to this year, I think it had 7 or 8 sort of weak earnings quarters. But what we like about it is it's a well-managed company. We think that they're particularly adept at balancing sort of necessary cost cutting along with making strategic investments at the same time. So we think it's a kind of a good sort of a value play.
And finally, Bill, how about Train? Where the street is actually fairly divided. I see 13 buys, 11 holds, 1 sell. Walk me through how you think about that.
Well, you may recall, Josh, from previous conversations, one of the things that we think about is sustainability as a investable theme and as a means of mitigating risk. Train has, number one, they're being very innovative in some of the products that they're launching. They've got an emerging market focus. They bought Stellar Energy Americas recently, which actually gives them access to data center thermal management market, or better access to it. One of the reasons why we like Train so much is specifically the data center, I don't know if you want to call it a vertical, but market. I think that is I think that provides a lot of resilience in terms of future revenues and future earnings. So we just think it's a good company.
Bill, thanks as always for your time and those picks. Appreciate it.
Josh, thanks for having me.
Coming up, we'll bring you the latest earnings from athleisure giant Lululemon. That's coming up next. Lululemon fourth quarter earnings are just now crossing the wire. Fourth quarter EPS 501. That's versus an estimate of 478. Revenue 3.64 billion. Consensus was 3.58 billion. Q4 total comp sales ex FX, that was plus 2%. Estimate was down 1.75%. Turning to guidance, Q1 EPS between 163 to 168. Estimate was 212. Q1 net revenue, the guidance between 2.4 to 2.43 billion. Estimate was closer to 2.48 billion. And then there is the sales outlook for the current year. Sales expected to be in the range of 11.35 to 11.5 billion in the current fiscal year. Top end of that range is in line with consensus. Also, other news from the company saying they announced the appointment of Chip Bergh. He, of course, former president and CEO of Levi Strauss, to its board of directors effective immediately. With that addition, Lululemon is saying they've added 5 new independent directors to the board in the last 5 years. The stock here, at least initially, we're down about 2%. Remember, heading into this print, that stock was down about 50% over the past 12 months. It was down about 20% already this year. Top of mind for investors, of course, behind the financial results, really the CEO search. Who's going to lead this company? We're looking for any kind of updates there on the search candidates. And then once they have that new CEO in place, what's going to be their strategy? What's going to be their priorities? Remember, there's an activist story here as well. Elliott Management has built up a stake. You also have the founder, Chip Wilson, wants to replace board members. So plenty of drama with this story. Most analysts, even though the stock has been battered, nearly 90% on the sidelines here with a hold ratings, so they are neutral. Other questions on the call you're going to get about, of course, the product pipeline, tariff mitigation efforts. Those will all be front and center on that conference call. Well, Lululemon Q4 results coming across moments ago. Let's get some more reaction now with David Swartz, Senior Equity Analyst at Morningstar. David, the results just crossing. Let's get your reaction, your response to those results, Dave. What do you think?
Yeah, it looks like the numbers were better than expected, which is nothing unusual for Lululemon. The company almost always seems to beat guidance, even in quarters that aren't very good, like this past one. So that's really not that surprising. I think the stock's reaction is to the guidance. The guidance for 2026 was a little bit below what I expected. I think I was about $12.90 in EPS. But Lululemon, again, has a history of guiding low. So I don't know that I would really see that as all that negative, because it's really not that different than what people expected. People probably hoped that Lululemon would come out with higher guidance and to give something to cheer about. But at this point, with the CEO search going on and all this uncertainty, and it's still very early in the year, it makes sense for Lululemon to not be too aggressive in its outlook.
In terms of that CEO search you mentioned there, David, maybe we'll get some updates on the call. We'll see. But any names you'd like to see, David, running this company?
Yeah, I don't know. The name that's out there is Jane Nielsen. She's been supported by Elliott, which is a shareholder. She is very well known to analysts who cover the sector because she used to be the CFO at Ralph Lauren and was very successful there. She would seemingly be a very strong candidate. Presumably she wants the job or her name wouldn't be out there, but we'll see. I don't know, though, if that will happen because there is a lot of bad blood between Lululemon's board and the activists, including Chip Wilson right now. So I kind of suspect that the board wants to be seen as independent and doesn't necessarily want to choose a CEO just because somebody recommended the person. So it seems like the search may take a while. It certainly can in this industry. Gap, for example, a few years ago, it took them an entire year to find a new CEO, and they found a very strong one who's been very successful so far. So it's really more important to take the time to find the right person rather than make a hasty decision. You mentioned the founder, Chip Wilson, and this campaign against the company's board, criticized the current management's willingness to invest, rely on heavy discounting. What did you make of that? Yeah, he has a lot of opinions, which he's been sharing on an unsolicited basis for years about Lululemon's progress. one thing to remember is that Lululemon had its best years after he left the company, which he kind of always seems to ignore. I do think that there are reasons to criticize Lululemon. The company has struggled over the last couple of years, especially with growth in the United States. There's a reason why, the CEO change is being made. So it's not any big surprise to people that, there are some problems. I think a lot of the issues have been with product development at Lululemon. It hasn't been as good as it was in the past. And the industry itself has also become much more competitive, which is something that Chip Wilson sort of ignores. This is not the sportswear market that it was 10 years ago. It's a lot more crowded now, and also Lululemon is a much bigger company than it used to be. So it's a lot harder for the company to generate growth.
In terms of that competitive landscape, David, who poses sort of the greatest, new competitive risks to Lululemon, in your opinion?
Well, there's no end of competitors, but certainly we've seen some that have come out of sort of obscurity in the last few years, such as On and Hoka on the footwear side primarily, although they're getting more into apparel as well. Then you have a resurgent Adidas, which was really struggling a few years ago, but has been doing better recently, and that's affected, for example, Nike. There's also a lot of older companies, that have sort of come back, like New Balance, for example, that have been strong. Skechers has been doing pretty well. So, this industry is very attractive because there aren't a lot of growth stories in apparel and footwear, and the sportswear part of it is still a growth area, and so that has attracted a lot of competition, and Lululemon needs to deal with that. And then direct competitors would be Alo, Yoga, and Vuori. Those are two that certainly have affected Lululemon in the last couple of years.
David, the company also did announce the appointment of Chip Bergh, so former president and CEO of Levi Strauss, to its board of directors effective immediately. What do you make of that news?
Yeah, it seems like a good addition. Levi actually owns a competitor of Lululemon itself called Beyond Yoga. There's no end of competitors out there. It's a much smaller competitor than Lululemon, obviously, but it does help to have somebody from the industry. And I think the next CEO will certainly be someone from the industry. We've seen in this space in the last few years, there have been some CEO hires from other industries. For example, Under Armour chose a CEO from Marriott, and that did not work out well. So it's really important to find somebody with experience in the apparel industry because it is such a tough industry. So that's a good hire, and I think that will help perhaps with the activist situation.
David, as always, appreciate that instant analysis. Thank you.
Thanks.
Time now for To Watch Wednesday, March 18th. Stocks bracing for a major news day with the Fed, inflation data, and key AI-linked earnings all in focus. Let's start here with the Federal Reserve. The Fed announcing its interest rate decision at Wednesday's FOMC meeting. Wall Street widely expecting the Fed to hold rates steady. Focus will turn to Fed Chair Jerome Powell's press conference and whether he signals greater confidence that inflation is cooling or suggests the Fed still needs more data before cutting. Yahoo Finance will begin coverage on Wednesday at 2 p.m. Eastern. Ahead of the Fed's decision, we'll be getting February's Producer Price Index. Economists forecasting headline PPI to cool to 0.3% month over month, with core holding at 0.3%. The new print helping shape the narrative around whether inflation pressures are easing. Turning to earnings, some key retail earnings coming out on Wednesday with Williams-Sonoma, Macy's, and Five Below. General Mills also rounding out the reports. Micron announcing results for its second quarter after the markets closed. Company is riding a powerful memory pricing cycle driven by AI demand. Analysts expecting results potentially beating consensus by a wide margin, making this a key read-through for the broader semiconductor and AI infrastructure trade. We'll also hear from Jabil, another important AI supply chain player. Company posting Q2 results on Wednesday. Analysts anticipating Jabil to post strong growth in its intelligent infrastructure segment tied to data centers, cloud, and liquid cooling. Coming up, we speak to a young AI startup founder about his company's potential unicorn status. That's coming up next. Hello and welcome to Asking for a Trend. AI startup Aru, founded in 2024 by teenagers, is now worth up to $1 billion. Turning heads with its growth momentum, co-founder and president Ned Ko joining me now. Ned, it is good to see you. So maybe, Ned, start by just explaining a bit about your company's mission, the kind of problem you're solving for, Ned. In simple terms, I was reading up on it. It sounded like, Ned, okay, you created sort of an AI system here, and it could replace traditional market research. So surveys, focus groups with AI agents. Am I thinking about it correctly?
Yeah, well, first off, thank you so much for having me on. It's really great to see you, and I really appreciate it. As far as I see it, market research is just the start, right? At the end of the day, what we do at Aru is we simulate human behavior. And if you believe that humans are the preeminent species on the planet, which I think you and I probably both do, you can do a lot with that, right? So some of it might be a much more research use case where you're simulating the behavior and asking someone's A/B opinion on an advertisement. Right, and then you might have the entire other side where someone comes to you with a question about how do I mitigate churn of my customers? And that's a lot larger than just traditional market research, but it's still something that we solve every day with our systems, which is really cool.
Ned, what's the kind of data you're feeding into this AI model?
Yeah, no, it's fascinating. We are in the Valley, right? We're operating at this time when human data has never been more important, right? You have companies building world models and large foundational labs that are spending hundreds of millions of dollars on PhDs to label math problems and all these sorts of things. And interestingly enough, we kind of operate at the antithesis of that, right? When you think about modeling behavior and simulating populations, one of the biggest core principles of what we do at Aru is that humans themselves are not accurate representations of what they actually do, right? People lie. You know, fortunately, both you and I are wearing clothes, and I highly doubt you asked Hugo Boss how much you were going to pay before that jacket, before you purchased it, right? The truth is, at the end of the day, is humans lie. They have biases and all these sorts of things. And when we build these models, both in the way we make sure we're properly generating the agents who we are going to simulate, making sure we have the right race, age, income, all those sorts of things, we never speak to humans, right? We look at things instead that are ground truth building blocks on what makes you and I who we are, right? We might look at a voter file, a credit card purchase history, a statistic on how many people in a certain area have running water. And then on the flip side, to actually model their behavior accurately, we'll look at things like vote counts and click-through rates and sales results instead of things like polls and surveys, again, because they are not indicative of what people actually do. And so we kind of operate at the back of that on a total reversal of using humans and instead looking at the outcomes-based data of what they actually do, which is really interesting.
Can you give us, Ned, like a hard example of your AI model at work, just to illustrate it?
No. For sure. Yeah. I mean, you can go as simple as saying, I'm going to launch a new product, right, for a soda brand. A very public partner of ours, interestingly enough, is Spindrift, right? And they're just putting out this large, initiative around putting forward a still drink for the first time. It's actually a tea, which is something you haven't done before. Traditionally, they're sparkling drinks, much more in that sort of area. What we'll be able to do is simulate an entire population of consumers within the US or whatever interested market they're looking at and identify, hey, let's put these packages in front of it. Are you going to buy this? What price are you willing to pay? What flavors do you want, right? All sorts of things that will be revolving around behavior to optimize a product deployment. And then even going on there from ads, right? And so on and so forth. So it's like a much, very consumer focused use case. Yeah.
And for the company, Ned, for your customer, is the benefit also, am I saving money? Am I saving time? Can I move faster?
Yeah, I mean, traditionally in decision making, whether it's around products, for example, or some other sort of area, you're spending months and months and months to come to a conclusion around doing these things. If you're using traditional human research, if you're using traditional strategy consultants, sorts of things like that. And so, of course, there's a massive amount of time where we're able to generate these entire populations in a matter of minutes, right, which has been really cool. As far as like the saving money thing, absolutely. These things have massive economies of scale as opposed to traditional people. The more you ask, the cheaper they don't get. But I had a mentor actually very early on who gave me the advice that you can only save a business so much money, right? We like to tell our customers a value story, right? And so we operate at the opposite end of that, which is, look, we're going to make you more efficient. We're going to do all these things, but we're going to help you make better decisions and grow your business a lot more, which is how I believe you should build an everlasting business. Yeah.
Ned, I got to ask, I had reading that you guys, you're young. I read that you started the company, Ned, just a couple years ago. You and the co-founder, you were something like 18, 19, Ned. Is that I'm curious, is that ever a challenge? Like you're talking to some CEO of some big company, and is it ever a challenge to get him to trust you guys, Ned, to really take the lead on what could be like a mission critical decision and project?
Look, I think it's a great point, right? I just became legally able to drink a couple of weeks ago, and we've been servicing alcohol businesses for the last year. So I think it's an interesting paradox. But absolutely, right? I think it is for every AI company, not just because we're young. A lot of people are putting out a lot of stuff. A lot of stuff sounds really exciting. So what we do at Aru, and the reason we've been able to grow so quickly, right? The business is exactly what you said, just under 2 years old. You're 19 when I started this company. My co-founder was 18, right? My other co-founder is even younger. I'm 21 now, and how we've been able to do this is just by making our value proposition so blatantly obvious in a pilot and in the first interaction with the business that if someone's executive who ends up hearing about that pilot being ran doesn't purchase it, we've literally seen people get fired as a result, right? What we pretty much do at first stages of entering a business is, look, people have sold predictive technology for a while. We say, let's prove it, right? I can try to convince you that magic is real, or I can show you. And so we'll ask a business. If it's a marketing use case, maybe I ask for an ad. And you know what research you ran, you know what decision you came to, you know what actually happened, whether A or B was better, and we'll run it blinded. We'll do it with product deployments. We'll do it with credit card perks, whatever it may be, right? We'll take something that you know about your business without taking any data from you. We'll run a simulation of that population, totally blinded, and prove that we're more accurate than whatever brought you that conclusion in the first place. So it's been this really, really cool thing of being able to prove from the outside in, demonstrate the capabilities of our system, and as a result, move very quickly into gaining the trust of our customers, which has been really cool.
You know, Ned, I read that you and correct me if I got this wrong, that you and your co-founders, you dropped out of college to pursue this, right? And these like, just so viewers understand, these really good colleges like Harvard, Dartmouth. I couldn't get into these colleges. And I just wondered, Ned, do you think maybe we're entering some new era where, companies could be founded by even younger founders than we're used to moving forward, that maybe AI could kind of lower the barrier to entry?
Yeah, absolutely. And don't cut yourself short. I'm sure you'd make it no problem. I was at Harvard for about 2.5 weeks before I left, which is quite amusing. But no, I think at the end of the day, in my opinion, like, these schools are great universities. It really is just about opportunity cost. Absolutely, to your point, the barrier to entry has been lowered. And I think that makes me as a tech founder think a lot about where do we want to spend our time to make sure our value proposition is so differentiated. To me, that's making sure the product is most usable to the customer, right? I'm in San Francisco right now at a friend's office. We made a very pointed decision to set up office in New York after being in SF for a short amount of time so that we could be near our customers, so that we could understand what a large enterprise actually needs out of a tech platform to use. So, people have always been creative. Right, people have always been able to build things at young ages. I think that has been massively, expanded now with obviously AI making things a lot more accessible. But I think things will be just as hard to build around product and making sure that things are tuned to the usability of customers, because that doesn't have as much to do with AI as much as it does to have with your ability as a founder and as a team to understand what the customer needs. So, yeah.
Ned, it was so great to have you on the show today. Thanks for your time. I appreciate it.
Fantastic. Thank you so much for having me, and have a great day. Really appreciate it. See you soon. Bye-bye.
Stick around. We talk about the latest with Bentley layoffs and the future of robo-taxis. That's next. Delta is raising its revenue outlook. Uber teaming up with Nvidia, and Bentley is cutting jobs. Here to round up all the headlines, we got Yahoo Finance senior analyst reporter Pras Submarine. All right, Pras, let's start with Delta. Raising revenue guidance. What is that? What's driving that? Is it corporate? Is it leisure? Is it both? What's going on?
Yeah, earlier today was the JP Morgan Industrials Conference, and Delta, as well as American Airlines, also presented there, and they upped their guidance from 5 to 7% to 7 to 9%. Not much, but it's still pretty decent. We talk about, they said the focus on the premium customer, the loyalty business, high margin products like the co-branded credit card, the remuneration from the cards is a big deal. But yes, what's happening is that demand is still strong. Even in this sort of uncertain times these days with the economy, and one thing we're going to talk about is insane fuel prices, right?
What do they say about those jet fuel prices?
Jet fuel prices are up a lot. Before even this happened today, California jet fuel prices were double what they were before. And Delta CEO Ed Bastian said today that they spend $400 million more alone this month in March on fuel prices compared to last year.
So are they raising prices to offset that?
Yeah, 100%. Yeah. They are raising prices. You might be noticing that now when you check for flights. They are definitely doing that. They're adjusting capacity too. They're going to make sure that they're not paying for that. They're going to make us, we pay for that. And they think that they can keep doing that and people will still buy tickets.
What about DHS funding, TSA agents? Any comment on that?
Nothing that I know of came up from Delta or American today, but they've had in the past. This is a big problem. Last year when we had the shutdown and the TSA agents were going on or were sort of missing, and it was mostly the air traffic controllers, right? He said after a week that's gonna be a major problem. So you're already seeing a lot of lines right now at various airports. 2.5, 3 hour lines to get in.
Imagine as you now walk into the teeth of spring break, by the way.
Yeah.
I mean, that's why I have to imagine.
It's going to hurt demand.
Political pressure,
it's going to hurt demand.
But I have to almost imagine the political pressure is just going to ramp up exponentially. I mean, it's going to get insane.
Yeah. I think that's definitely going to happen. But for the moment, things are good in the airline industry. And I'm actually honestly quite surprised that they did this, raising their revenue guidance, given the fact that, fuel prices are so high. At some point, you're going to have some demand destruction, right?
Switching gears, another story in your wheelhouse. Our colleague Dan Howley writing about this one. Uber to roll out NVIDIA-powered self-driving taxis in 2027. What do you make of it? There's Howley in a Waymo, by the way, in case you were wondering.
We've been seeing more and more about this stuff.
Look how happy he looks.
He's very happy.
Yeah.
He loves technology, this guy. He's a big tech guy. But we've been seeing more and more about with regards to Waymo. See, I knew it. That's what happened.
Well,
Uber.
The producers do that on purpose.
So at NVIDIA's GTC, they had more information here, right? Talking about their partner Uber, which they're going to, have hundreds of thousands of eventually of these robo taxis. But for the here and now, what they said that they're going to roll out these level 4 autonomous vehicles in LA and San Francisco first next year, 2027. That was the new news today. Eventually going to go to 28 cities across 4 continents. So that's how that expansion is going to go. We'll also include other partners like Lyft and other various local ride-hailing companies. They're going to be part of that network that's going to use NVIDIA-powered technology, both hardware and also their software, like the Alpameo, which is that their OS that sort of runs things. So a lot going on in the space, and you just saw Howley and the Waymo. And the Waymo is considered the leader there, and I think Uber wants to catch up.
Big picture, when you think about robo-taxis, like as a market, what would you say would be the big hurdles? Like, is it regulation? Is it safety? Is it just making the economics work?
I think regulation is a hurdle, but you can see Waymo, they're surmounting that. They're proving the case of how this stuff works, and they're growing almost every month. You'll see a new region or territory added. But I think the bigger problem is technology-wise, right? We're seeing all these the announcements, the Nvidia's, the tech, the software. I still think that. Personally, I think that there's still a lot of challenges to take place on these so-called edge cases, right? You can work in a small little sandbox, but what happens when you're going off from the highway into a small town, into a city? How do you do true end-to-end self-driving? I think that's still a technological issue to deal with. You still need a lot of data, you still need a lot of compute power, and it needs to be sort of iterated. And I think that might be the big challenge right now is you hit a wall at a certain point, and when I see it in New York City, when they're actively working in New York City, as you can tell, pedestrians, bikers, kids running around. Then you know it's been solved. Finally,
Bentley, you reported this one out, posted 7th consecutive year of profitability, but cutting some jobs. What's going on there?
Yeah, it's they're not the latest to do this in the luxury space, right? Aston Martin also do this as well, but around 250 positions in the non-manufacturing sector there for them. The company's still making some money, but not as much as before, focusing on higher end things like customizations, those are the areas where they get more high margin, higher end trim levels. But this is the future of the business, right? They're kind of right sizing themselves ahead of what will be their next trend, which is going to be potentially an EV rollout, which is also kind of masked with further questions.
Did you see this story? Like, okay, that's a Bentley specific story, or no? Could that be a sign of like broader cracks in the luxury market?
They were making it sound like nothing wrong here. We're just sort of, this is all strategic, but you don't necessarily do layoffs if you're fine, right? In fact, you might be growing. You want to hire more people, and I think they're seeing that we might need to retrench a little bit because the market's a little bit uncertain. We're still making money, but maybe not as much as before, and they're selling less cars, so maybe focus on more expensive, higher-end trimmed or customized cars. Not necessarily a good thing when Ferrari itself is still growing, but I think we'll hear more from Ferrari later, but I think that there might be some hesitancy on the face of even the richest people talking about maybe now is not the right time for me to buy a $300,000 SUV, right? Even the most wealthy people will say, maybe we should pull back a little bit. Right. I think that's the problem.
Pras, thank you, buddy. Appreciate it. With all the uncertainty swirling around the housing market, Yahoo Finance executive editor Brian Sozzi sat down with the Property brothers, Drew and Jonathan Scott, for their keen insights.
It's a time where Jonathan and I, our faces are fading fast, so we're like, get as many shows under our belt as possible. Yeah. So what we've done over 1,000 renovations. We've done 650 episodes of our shows. But Property Brothers Under Pressure is a whole other level because it's so relatable. The housing crisis and the pressure everyone is under when it comes to finding a home that actually works for your family.
And we're kind of showing it almost doc style, where a lot of the stuff that used to happen off camera, behind the scenes, we're just showing it. You see everything. You see the crew. You see like last minute butting of heads, you see everything.
And the stories as well. See, I get emotional when I talk about it.
I see it.
The stories are so impactful as well and emotionally connecting for the audience too, because there's a lot of things you can relate to. For example, our first episode is a family that lost everything in the fires in LA, in the Eaton fire. And so this is them trying to build back their lives. They literally lost everything of theirs from their home. We have other families that can't afford to live where they work, and so family members have moved together with their kids to have two families in one house to try and be able to afford where they want to be. Every story is very, very unique, but I love it because it's so relatable.
I'm glad you mentioned the housing affordability. I live in Long Island, and there was a tiny house that just sold for $330,000. It has no rooms. It is, as you walk in, it's just this blob of a thing. I mean, that's what we're looking here. That's a real crisis.
And I wish people would take it more seriously, because every time, we're talking about affordability, we're talking about the housing shortage, and then a year later, we're talking about it again, except the stats have gotten worse. And so people need to start figuring out, at the government level, we need to figure out financing programs that incentivize people to build affordable housing. And then at the everyday level, people need to understand affordable housing is good for the city. We need it, but the NIMBYs are the ones who block a lot of it and say, I don't want another apartment building, or I don't want to have low-income housing. They don't understand that low income does not mean that it's it's drugs and crime and things. It's nurses and teachers and police officers. It's all this in a space where they can live and work in the same community.
And you look at the stats. I think that I saw. Sorry, I'm getting my allergies or something. Excuse me. But the stats are saying like this is, in modern history, this is the worst for affordable housing. This is the worst it's ever been for first-time home buyers. And you see first-time buyers are 25% or less of purchases right now. So it's
I saw a stat that was crazy. It said that the new median age in America for a first-time buyer, or sorry, it's not first time.
It's 55.
55.
Really?
It's 56.
Oh my gosh, that's
It said the
crazy.
new median age for the average buyer, not first-time buyer, but the average buyer is 56. That is crazy.
That is crazy. We hear so many different roadblocks, that the houses cost too much, there's not enough supply. You mentioned some of the challenges from the government perspective. What is the biggest challenge? Is it the government roadblocks?
Supply is the biggest problem.
Supply, and then the reason for supply is a number of things. Even there's another stat that was saying that there are so many. I can't remember what the surplus is, but there's so many houses in the country that the government keeps saying, okay, well, here's how many houses we have, but a huge portion of that is people who own second and third homes, and they just leave these extra houses empty or these apartments empty.
They got to sell these things.
It's fine if somebody has the means and wants to have something else, but that shouldn't that shouldn't come out of the inventory that we need. We're about 4 million houses short in the country from a healthy supply of houses.
Yeah, and you look at the. Every time I'm going to talk, I'm going to clear my voice just for you guys.
Yes, we can even AI him out now. We don't even need him.
All right, let's AI him back in here.
Yeah, so more people are renovating right now because they can't afford to get a new place. They couldn't even afford to sell their house and find something new. And so, the renovations have gone up. I think it's up 30 or 40% or more. However, with people with their properties that they're owning, I think that the hardest thing, the supply side, rates don't matter. Rates have come down, which is great. It makes people excited to buy. But if you have no supply, the rate change doesn't make that big a difference. So we need to solve some of these issues, building more density, the government side of it. If we have the process for getting your permits and getting things in place is a little bit easier. Incentives for developers to do affordable housing is a huge thing. We come from Canada. Great incentives up in Canada that really help developers dive in. Here, we don't have any of that. And also, I think something that would be great is everyone's so scared of AI and what AI is going to do. If AI could shorten the permit timeline, that alone would make logical. AI worth it.
It could do everything else.
If everyone wants to join me on my crusade to work with the utilities and the cities to reduce the weight on all of those services. There are so many projects where I have the project either ready to go and we're waiting for 6 months or 8 months or even a year just on permits, or the only exception actually was rebuilding my fiance's family home in the Palisades that burned. My permit was approved in less than 3 weeks. They're so focused on making sure they can help people build back that they've created pop-up permit offices. But everywhere else, it's either the utilities or it's the cities that are delaying these for no real reason.
So if I'm 55 and I want to buy my first house today, what advice would you give me? I'm not 55, to be clear.
I was going to say, you look
I'm not
great.
55. I do look great.
Yeah. No, I mean, so it's tough. Again, on Property Brothers Under Pressure, you see this as well. People are finding creative ways to get into home ownership that they never thought they could get into before. But I think the main thing is understanding what your needs are if you need to be in a certain area. The tough thing for a lot of families is if they have to be in LA or New York because of family or whatever reason, their job, that's the tough thing. If there are other people that could float and be somewhere else, then go somewhere that's a bit more affordable that you can get more bang for your buck and it helps. I know we're leaning in on the government side to try and see what we can do. We own a modular company for building homes, and that's one way to bring the price point down. But the thing I find very annoying is there are a lot of people out there, even after the fires in LA or just in general with affordability, they're taking advantage of homeowners. For example, when the Inflation Reduction Act came in, it had a whole bunch of incentives to help families create a healthier home environment, electrify their home. But a lot of the service providers, or like HVAC providers, for example, they were just upping their prices by what the difference of the rebate was, and therefore there's no benefit to the homeowner. It just all goes to the manufacturers or the service people.
So I should not buy that overpriced tiny home.
That $300,000 one-room house, not a good investment.
You can move in with us.
But I appreciate that. What mistakes are you still seeing people make?
So right now, it is very important that people make smart financial decisions when they're buying or renovating a home. And some people will get so emotionally charged that they'll run in a direction, they'll do something that they're never going to recoup that money if they have to sell. I always say there's two types of renovations that you do. There's renovations that will actually increase the value of a home and you will get more money for that thing that you put in when you sell. There's other stuff that it may help you sell, people really like it looks pretty, but you're not getting any more money.
Yeah, I would say don't over leverage. There's still a lot of people that are putting themselves a bit too thin. If you're looking at getting a place, a lot of people are going from a house into a condo because they can't afford a house. But in reality, if you can get a house with a rental suite, the money generated from the rental suite should be able to offset more than what you'll end up paying with your condo along with your HOA fees and everything else. So look for a creative solution like that. Or is there somebody that you could live with? Is there somebody that you can get into a place where you each have your own suite?
I'm not moving back in with my mom. I can't do it, guys. Like it has not come to that. Oh my God, Jesus, no way.
Give it time.
No. So what? If you look at forward here, like what are the biggest trends you're seeing in the renovation market? Last time we talked, you were talking about how we're going to have to remodel our homes at some point because of the baby boomers. We're going to have to add railings in various parts of our home. Is there something else you guys are seeing now, if we do in fact get a home?
I mean, the big thing I'm seeing mostly is people want specialty rooms at home. So instead of having to get a gym membership and go to a gym all the time, they want to have a home gym or a Zen zone or a sports facility, a cold plunge. Yeah. So we're seeing all of these requests for spaces that used to be a spa or a gym or somewhere else. People are including those at home. Even
because people don't want to be spending, their monthly expenses are crazy. It's through the roof. That's one of the biggest issues as well right now when it comes to people living somewhere is they can't afford the monthly payments. So if you can streamline any of that to have the enjoyable life, the entertainment side of it at home, great. But also we're seeing a lot of people who are getting a place where they can they'll get a 2-bedroom home but add a 3rd bedroom. In fact, we have that in one of our episodes as well. We created a bedroom for the kids because they were cramped in their home. So I think of what's important to you and what you're looking at. I know you don't want to live with mom.
No, hell no.
But what else would you squeeze into your house?
I like the Zen room. Yeah. I like the Zen room. Ideally, I walk in, there's a cold plunge, a sauna, and I don't know, maybe a bunch of Sonos speakers.
In your kitchen? You want it all in one spot?
Yeah, just all in one spot.
I want to sit on the toilet, a smart toilet,
yes.
with my sauna right there.
We're not going there, guys. Yeah. We're not going there. Since we last spoke, I think you are now on a Canadian hockey team? How is that like different than what you do? How do you renovate a hockey team?
Yeah, right, exactly. I mean, it's business is business in many ways, but it is very different. It's the Vancouver Giants are a major junior team in the CHL, in the Western Hockey League. And Michael Bublé and I are owners. He got me into that. We're both from Vancouver, and it's sort of supporting our hometown. We love it. I mean, I've always been passionate. Jonathan would make fun of me over the years. I'm just such a sport nut. Mm-hmm. And so to now be a part of owning a franchise is so exciting for me. And these kids, they're one level below pro. I mean, some of them, 2 of our kids are probably going to go top 10 in the NHL draft this year. Wow. And they're all teenagers. It's just crazy to me to see the talent level that is at that.
I saw a post on X recently, lastly, that they might want to bring back the Expos. I mean, who doesn't love the Montreal Expos?
I mean, come on, why not?
Maybe you get involved with that.
You know what I want? I want them to bring back we won't be bringing back the Grizzlies, but I want an NBA team in Vancouver as well. So that's I'll rally for that. We'll get basketball back there.
All right, well, good to see you guys as always. Thanks for always making time for me, and good luck on the new show. Love the name, love what you guys are doing. I love that you're just not like renovating homes. You're taking people through the buying process.
You know what I love?
Because this stuff is hard, man.
Yeah. I love Mom. Say hi to Mom. No. She got hit hard in this interview. I think Mom's great.
She always watches. She already likes you guys. You don't have to do that, all right? Good to see you guys. I appreciate it.
That's a wrap on today's show. Thanks for watching.